Welcome everyone. Thanks for joining me again. We're going to look at a theta trade. And before we do, take a look at the risk disclosure here. In fact, you might want to pause the screen or take an image of that just to point out that past performance is never a guarantee of future results and only risk capital should be used when trading. All right, I wanted to point out something here. Here's a tweet, and it's about the Russell 2000, the small cap stock market index. They mention here that Bloomberg is reporting the Russell 2000 index companies have 832 billion of debt on their balance sheet, and that all needs to be refinanced, or at least 75% of it, in the next few years here. And of course, that'll have to be refinanced at much higher rates than what they were initially financed at. And comparing the S&P 500, there's only 50% of the debt in that index that's coming due at the same time. So the Russell is sort of in bad shape in that regard. And also 42% of the Russell 2000 companies are unprofitable currently. And the index is still well below its all-time high, 16% below its all-time high. So with that in mind, why don't we look at a trade on the Russell 2000? And this will be more of a non-directional trade, not necessarily projecting a large decline or increase. And we're going to look at an iron condor on the Russell. We chose the neutral tab here, looked at the Russell 2000, the E-mini. We looked at the iron condors, and we're choosing this one here. The algorithm has given us some to select from, and we've chosen this one here with 53 days till expiration. And we're looking at the chart here, sort of the overhead view. You can see the call spread that's being sold and the put spread that's being sold. And the idea with the Condor is you look for the market to stay in this wide range. And then as time passes, you can buy back the put spread and the call spread for less money than what you received. And that would be the ideal outcome. And of course, that would be due to theta decay. And here's the table. Why don't I zoom in just a little bit? You can see it easier. You can see all the particulars and details. We won't go into each one, but you can see the expiration date, your net premium being collected. That's with a quantity of 5. We'll just jump down to 1 kind of as our starting point. And you can see all the numbers change. Your cash required, your profit potential at expiration. This is your targeted return on cash and targeted annualized return at expiration. Keep in mind this number here is not to suggest you'll generate 43% a year by placing this trade. What it does is compare one condor to another. You can see how the trades that have more time compared to less time can vary in that targeted annualized return. In any case, so the algorithm has chosen to sell the 1875 put with a delta of 8.28. So that means there's over a 91% probability that this option would expire out of the money. That's what the math tells us. And then the call that's being sold, 5.31 delta. So you're looking at, over 94% probability that this call that you're selling will expire out of the money. So the algorithm liked those particular strikes and then chose these particular strikes as well to provide a hedge against selling these out of the money calls and puts. And we can increase the quantity. You can see it changes all the numbers and the data. And let's just suggest we'll do 5 of these. And that's the result there. And to place that order, you just click the button. That's all you have to do. All right, well, that'll do it for today's Theta Trade on the Russell 2000. And thanks for joining us.